So trying to, manage that with family, it makes it very difficult to, to want to even think about taxes. But when you, at the end of the year, when you go back and you realize that you are falling, into what, 24%, 22%, even 30% tax bracket, now you
Extreme.
have to start thinking about it. It's like, okay, I need to change something, right? So yeah, I guess for me, I personally I can relate because
Yeah.
it was so painful. Terrence, thank you so much for joining me today on my podcast. As you are aware, we've been working together for the
Yes.
past few years. You've helped me save a lot on taxes, and I thought it would make a lot of sense to invite you to come and share some of your knowledge with my audience. So, as you are aware, on this podcast, we usually talk about wealth creation, leaving a legacy, and leveraging real estate to do that.
Right.
So, I guess looking at the entire scheme of real estate, there is a lot of misconceptions when it comes to taxes. Some of it happens to be tax planning, right? Because
Mhm.
most often people just either pay for some software to file their taxes,
Right.
which I used to have that same mindset, but I got to a point where I realized that I was actually cheating myself
True.
and probably also making a lot of errors that could come back and hunt me, or
True.
because IRS is more likely going to start auditing me because
Absolutely.
of my real estate investments and even other investment portfolios that I had.
Hmm.
So working with you has helped me a lot. Now I do understand taxes a lot. So
Right.
I think this episode there is going to be one of the best episodes for anyone who will ever listen to it. So let's start with tax planning. Why do you think some high value individuals or professionals or even entrepreneurs think that tax planning is actually for the ultra wealthy, extremely rich people?
First of all, Patrick, thank you so much for having me on your platform. I really appreciate it. And this topic on taxes and tax planning is really, it's a passionate area for me, especially because in my day to day, I get to interact a lot with the high income individuals or high net worth individuals
Mm-hmm.
or business owners with growing businesses.
Yeah.
And I see that their tax exposure, that's probably one of, if not the biggest expense that they have,
Okay.
just that tax bill. And when I look at the concern, I think is mostly a function of maybe lack of knowledge. So you're
Yeah.
thinking there may not be anything here for me. When I say anything here for me, anything in the tax code for me
Right.
that can help me to mitigate this exposure. I would say that lack of knowledge, and then sometimes too, if you think about it, say if we take an example of a high income professional,
Mm-hmm.
they probably don't have time. Their
Yes.
jobs are demanding.
Yes.
They have so much effort and momentum that they need to, and focus that they need to put into their craft to keep adding on that 10,000 hours.
True.
So they may just be deficient just from a knowledge standpoint of what is potentially available for them from a
Mm-hmm.
tax standpoint. And
Right.
so that can easily give that impression of helplessness, right? That my tax bill is what it is, and I just have to pay it. And so I think that's what I see for the most part. And even if we switch that, maybe a business owner with a growing business, they probably fall into that same bracket as well, where they're just so focused in trying to grow their business. They're just ultra focused and so invested. And so, even though it's an important aspect of their business, this whole idea of managing their tax exposure, it may not necessarily come in front and center because
Mm-hmm.
they have a business in front of them and they have clients to serve every day and problems to solve. So it's probably a mixture of one of those, just maybe lack of awareness, and then they're just in this lane where they are focused on trying to pursue either this career path or this business that they've started, And being in those lanes sometimes may just unfortunately give them that perception that maybe tax planning there's nothing in there for them, and then ultimately results in this huge tax exposure.
And Terrence, I agree with you because I can relate. If you
Exactly.
remember, 3 or 4 years ago when we started, right?
I know.
I hated taxes. I didn't want to even hear anything about taxes because I was so used to W-2, right?
True.
So already taking my taxes out. I don't care.
Exactly.
I don't want to deal with it. At the end of the when it's during tax season, let me pay somebody maybe $200 or $500 just to get my
Right.
taxes filed, right? Now this is a situation where I'm an investor, right? And I started feeling the pain, even left alone bookkeeping, which, as you've seen, I've gotten better at it
Absolutely.
because I had no clue of what I was doing. And to your point, being a professional or a very busy, high individual who has a six-figure income, whether it's from your salary or from your business, anybody within that bracket always knows that to be bringing that much home
Yes,
requires a lot out
it
of
does.
you,
It
right?
does. It
So
really.
trying to manage that with family, it makes it very difficult to want to even think about taxes. But at the end of the year, when you go back and you realize that you are falling into what, 24%, 22%, even 30% tax bracket, now you
Extreme.
have to start thinking about it. I need to change something, right? So I guess for me, I personally I can relate because
Yeah.
it was so painful. And even my path of my journey from a real estate investor, now a real estate agent also has to do with the fact that I needed to claim all my losses from my initial real estate
Yes.
investment, right?
Yes.
Which I was limited because I was making way too much. And
Yes.
so the tax code was restricting me from shifting all my losses from my initial real estate business onto my W-2 side, right? And I guess after working with you, you were able to advise us to also look into becoming real estate professionals. So
Absolutely.
I agree with that, and I can also I relate.
I love what you just talked about, your personal story, and I guess I don't want to say transition, but this idea of moving from where you have, say, just strictly W-2, high income,
Yes.
W-2
Right.
income, and then now you have this new situation coming on that on the real estate investing side or
Right.
on the real estate agency side. And
Right.
that picture in and of itself actually paints that's actually a good backdrop to talk about here, where there's almost two tax systems that are at play here. So one of them
Yes.
is if you are a W-2 earner, right? Think
Mm-hmm.
about what happens. You actually referenced it. You earn your income, right, from the employment,
Right.
and then you pay the tax. So number one, you
Yes.
earn the income. Number two, you pay the tax. And then number three is whatever remains net of your tax obligations. If your tax are being withheld upfront, then whatever remains is what's yours, right? And
Yes.
then guess what? Come the end of the year, if that withholding wasn't sufficient, you still may have another tax obligation
Yep.
waiting for you by April 15th.
Yep. Yep.
So that's one side of the equation, right? And then the other one now is you are either an investor or a real estate agent or stepping away a little bit from real estate, but self-employed or business owner. Now the whole tax system kind of in a good way in the sense that now you earn your income, however
Right.
way, if it's rental income, if it's commissions, whatever it is. And then you have the ability to now activate whatever is available in the tax code, right? To offset from all that income,
Yes.
then only what remains after those deductions or
Mm-hmm.
write-offs is what has a tax consequence to you. So,
Right.
so when you compare these two, I guess, situations, you then realize that if you do have control to the extent that the IRS tax code gives you over what you can write off or what you can offset, you want to try and maximize that, because that is the benefit you have that your other counterpart who is high earning on the W-2 side may not necessarily have. They have something, but it's obviously limited.
Right.
They may not be able to activate all these other things. So that's where, referencing to your earlier question, that maybe it's just you don't have the information. You just don't know what's available for you under this alternative system that you can absolutely maximize and extract the maximum possible benefits as Paris allows. So it's a really important distinction, because the more you transition from the W-2 into this new environment, you get that knowledge or engage with someone who has the heart of a teacher and can kind of your hand and be available to walk you through what those options are, because that be the difference between what you gonna owe, and in a sense it will impact. You talked about wealth creation in your introduction and things like that. You are shortchanging yourself by overpaying when you could avoid that, and then it kind of in your
exactly. So, which is interesting though, as you may know, not only my audience U.S. Individuals or U.S. citizens, I also have foreign nationals, where some of them, the fact that they are doing business in America, or they are receiving an income or revenue, right? They are supposed to file their taxes, right? So I know there is a misconception also among foreign nationals that believe that there is a disadvantage in investing in the U.S. Real estate because they don't know the tax implications. Can you touch a little bit on that for me? So, assuming a foreign national has purchased their first real estate property in the U.S., they are using it for rental and holding, at least for a year, they have to file taxes, right? Can you touch on it? Because I really want to change that thinking, that limiting belief that most people have about taxes, in a way it will give them the power or enable them to actually pursue the American dream, or of course, the world, and also leaving the legacy that a whole podcast is about.
I can imagine if I was investing in an overseas country, I would have the same concerns. So when we talk about a non-US investor who has bought their first rental property in the United States, a couple of things that come to mind. First of all, I would say it may be, talking general, it may be good on their end to try to engage some type of international tax advisor, specialized international tax, because there's two different tax regimes that they will have to contend. There's obviously one here in the United States, which, but there's also another one in their home country that needs to come into the equation as well, depending on how how their citizens, if they're earning income, maybe another country or things of that nature. And it leads me perfectly into, I maybe think of, our tax treaties between the United States and this other country, because sometimes these tax treaties between countries, between the United States and that other country, can dictate how the tax treatment of your earnings in this country may be treated. I can think of something like, for example, double taxation. I know if there's sometimes it's a concern, international, say investors where, my is in the United States, so I have to pay in the United States, that's fine. But will I have a corresponding obligation to pay tax on the same income in my home country? Because if that's the case, it almost kind of excitement to buy it, maybe something like looking at of tax treaties, if available, between the United States and their country, and what is included in there that they need to be aware of. I think that's why having if it's a consultant who does, say, international taxes, to that. But if you have your property in the United States, I think the beauty is the property is here, so you are able to activate the tax benefits, tax write-offs, tax privileges that an investment in rental property in the United States. So I'm thinking, okay, you have your tenant in there, you're earning your rental. You are just as eligible to deduct all the ordinary and necessary expenses that you incur in managing that property and earning that rental income. So I am thinking, you probably will have to pay property taxes, property. So you have a write-off, there. You probably need, insurance. You have write-offs. It depends. Maybe some management companies, they manage this. You have fees to pay to those agencies. So the write-offs that already that you are already eligible for by virtue of owning this property in the United States that you definitely want to take advantage of. So there's tax write-offs, and then the couple I want to mention, I feel like that are really important just the thought process of, okay, do I want to invest into the US real estate market, and what does that mean? There are obviously other tax strategies that we see and that are really, really popular, in real estate. For example, you want a property maybe long-term, you may have a life event that happens, maybe you need to sell, maybe the property wasn't as ideal or preferred as maybe you thought before you purchased it, maybe you want to sell it. You have opportunities to avoid or defer capital gains that will accrue on the sale of the property. You need to, right? You can do a 1031 exchange where you sell the property and use the process of the sale to buy another one. Maybe you want, maybe you're moving from maybe just the single. You want to move into a multi, family residence. By doing that, guess what? You, in a sense, are actually preserving, even though you're growing your wealth, but you're preserving it in the sense that you're avoiding a capital gains tax bill that was, activated by the sale of this property. So you take advantage of that and grow your portfolio now to maybe a bigger property, but in the same vein, a tax hit that could potentially have cause you to have to pay a significant amount taxes to the agencies. So you being able to tax benefit, that's a tax strategy that's available to you because you are you own a real estate in the United States. May be a non US resident, and like besides the 1041 exchange we talked about, that you can claim on your real estate portfolio to accelerate it offs, to make sure that only as little of the rental income you earned will be available to these agencies to tax you. So obviously you need to do maybe a cost, which I know.
But I do have a quick question though. You did touch on something, and I need to clarify two things.
Yes.
One of them happens to be the cash flow, right? The income coming from rental, right?
Yes.
So let's say, for instance, I own a single family home. Let's say it's bringing in a rental of, let's say, 3,000, right?
Okay.
After mortgage payment and everything, putting some away, repairs and stuff like that, my cash flow may be $200, right?
Okay.
So that flow, is it taxable, or it's just that is going straight into my pocket?
Absolutely taxable. Absolutely taxable, because it's taxable because this property is in you have earned income there from the rental activity pursued. So if you have a profit of $200 a year, that is taxable income to you, and so you will have a tax filing obligation in the United States to report that income and pay the tax that is due on that gain.
So I get that part. So then because from what I'm hearing, the big difference for for a foreign national owning a real estate in the US for an investor, right? As whether it's buy and hold or flips, right? That person, so that person will have to fulfill their tax obligations in countries. That is the one difference, right?
Yes, I
Compared to
think
a US
that one,
citizen.
Patrick, I think is it's I think it because different countries have different.
Right. I guess the point I'm trying to make is that, right? That on
Awesome.
the side, it doesn't matter whether the person is a US person or a foreign national, as long as they own investment property in the United States, they are entitled to the same tax write-offs or tax benefits. The reason why
Correct.
I'm asking that is going back to my initial question about the misconception. Most
Mhm.
people think that U.S. persons have a different tax code from foreign nationals when it comes to real estate or investment. I just wanted to clarify that.
I understand. I understand. I think the only difference that may
Mhm.
come is you are a US person that depending on how the like if it's an individually owned property, like it's in your own name,
Mhm.
you may have to file a different tax form. But
Okay,
the 1040 for non that 1040 for non-residents has its own, the taxes they are treated differently from if
I
you are
see.
right,
I
but
see.
you
Okay,
have but you absolutely have the tax obligation to file. You have
okay,
it for sure. Now the form
okay,
could be, but the obligation to file doesn't go away. And with
okay.
write-offs that are available only because the property is here in the United States, I think that's
Hmm.
what activates you to be able to claim them, because the property is here in the United States, and so even though the ownership could be different, but the property is here, and the benefits are accrued to your estate property owner. Like,
Okay,
can you write off property taxes? Yes, because they are paid on located in the United States. So the tax filing form may be different,
okay,
but the benefits that you from being a real estate investor and the tax strategies that you can employ will be the same. You don't
okay,
lose out on those. Yeah. And that's
okay,
the real attraction, really. I think
okay.
that can pull some investors to want to do if it meets, their risk profile and everything else.
Right. And the reason why I ask is from experience, based on the questions that I've gotten from some of my clients, is
Mhm.
okay, in the United States, you guys pay too much taxes. I don't even understand the taxes, right? So trying to invest here, how is that going to help me, right? And we also have even US persons that don't
True.
even understand taxes. Just like, I was telling my story, transitioning from, strictly W2 to now with a hybrid.
It's
Yeah,
a hybrid,
because I still have W2 and I still have, how do we call it?
a growing,
Three, three growing businesses, right? Which two of them is related to, real estate, right? So
right.
I want to clear some of these misconceptions before we looking at some of, because
Okay.
from what I'm hearing, if you don't know, it's more likely that you are going to leave a lot of money on the table, or you are going to end up paying more, right? So, to wrap up on this episode, based on your experience, can you tell us some of your clients have experienced, the challenges, the pains that they've experienced based on the fact that they didn't tax? You can use me as an example, right? Before they started working with you, and the transition that you've seen, in the knowledge, but also the tax benefits, how they've been able to, some of the pains that they were experiencing before started working with you.
I would say the biggest pain point is just the high tax comes with not being proactive in this whole in this whole process. By far, most of the times when I see clients coming in, an experience in a previous year where they've had to pay huge amounts. And so there's an emotion that's attached to your tax obligations. You know what I mean? Like
Yeah.
writing that check
It's
in and
painful.
Yeah. And so it's
It's
almost like
painful.
that is the
Yeah.
trigger that gets them out of their seat to say, hey, let me see, let me try and find out what is out there, what
Okay.
else is available that I can. I think by far that's probably the biggest pain, that pain point of having to an exorbitant amount of taxes, and then realizing the back end that hey, maybe some was actually avoidable, and then for some, it could be their pain point may that I actually have one client who situation like this. Their pain point was they had done a 1031 exchange. Previously, they were filing taxes by themselves, and then 1 year they actually did a 1031 exchange. Then come tax time with how to report that 1031 exchange on their tax return to make sure that the capital gain on the property that they sold does not flow through to be taxed as income, because this 1031 should defer it. That was their pain point. They didn't know needed reflected on the tax return. So there's obviously that lack of that technical expertise where you hear about strategies online or social media. Then that's one thing, and then it's a whole nother thing to really implement that
Yeah.
strategy and implement it in a way that aligns with what the IRS, what the IRS regulations, would dictate. And then another about it, if someone is just starting on in, the real estate, it's a like area I haven't pursued before. And
Right.
so they know you're going in blind. And so what you don't know with the IRS is they don't owe you anything. Like they
Yep.
don't owe you, like, hey, Patrick, you forgot, they don't owe you anything. It's on you. So it's almost always that you're going in blind, and you feel that inadequacy from a standpoint, and then you're just and then reaching out to get the assistance you need. And then some taxpayers too, it was an audit, right?
Yep.
Maybe they are in real estate, but they don't qualify as a real estate professional. Losses that they from their other ordinary income, but they weren't eligible to do that, and then they
Right.
were picked for audit. Now, maybe they're just looking for representation and just trying to figure out, hey, why are the IRS looking at this?
Right.
And then from there they realize, oh my goodness, the tax treatment was not, and maybe that triggered a flag with the IRS. Maybe they had a bigger unusual, and then
I
maybe
see.
so really the pain points could come from so many different areas, but I would say most times it's either one of those.
Okay.
Yeah.
Thank you so much, Terrence. This is very, very informative, and I do appreciate you joining us. I know we are going to continue on the next episode to actually drill down to some of the things that you actually touch up on. But I really want to thank you for your time.
Thank you, Patrick.
Okay.